Well, of course, let's take our attention to the Kenyan market and check in on what we saw on that end for the day. NSE 24,918 points. The market rallying there by 1.5%. That's as the likes of Safaricom touched a 5-year high today, and certainly trade in that stock accounting for 3/4 of the turnover on the day, and all in the back of the results we saw yesterday. In the meantime, on the currency front, sitting at 83.85 against the US dollar, you're looking at dollar up by 1/3% as it stands this hour. Well, certainly what we have seen from the shilling is it holding steady against the dollar. Traders are now coming through and saying it's likely to come under pressure in the second half of this month. That's as a result of increased government spending and lower interest rates. So let's take a look at this. Let's take a look at upcoming bond auctions and what that's meant to do for the appetite for Kenyan debt. We've got us joining us from our Nairobi studios, Solomon Alubala, head of Treasury and National at National Bank of Kenya, and Kenneth Minjiri, fixed income analyst at Stanlib Kenya. They're both sitting in our Nairobi studios. Solomon, from the currency perspective, I'll kick off with you, because what we have seen from the shilling is certainly boxing in a tight range for some time now. Even the Central Bank of Kenya remarking on the stability in the shilling and the fact that it has maintained its strength. Firstly, what do you see as the key drivers for the shilling when it comes to the fact that it hasn't really broken out of any substantial technical levels recently?
I think what we could do is look at how the shilling has been performing from the beginning of this year. Before the elections, we saw the shilling deepening. Actually, it depreciated to 88. We've seen it strengthen after election, mainly because of the peaceful election and economic sentiments, which are looking positive. If you look at the stock market, it has actually been going up. The turnover is twice as much as it was the same period last year. And as a result, we've seen the shilling strengthening. But on the central bank point of view, we're seeing the central bank supporting a stable shilling. Reason being, if we have the shilling go towards 80, then you'll have an adverse effect on the current account deficit. Mm-hmm. So at the moment, we're going to see the shilling continue being boxed in a small range, being supported mainly by the central bank, which is actually has been in the market to buy dollars. Currently, if you look at the reserves for the central bank, they've increased from 4.9 million up to 5.7 from January to April this year. So this is a major indicator that the central bank is more keen on a more stable currency.
Mm-hmm. Kenneth, when it comes to flows into the equity and bond markets, many remarking in terms of the turnover you're seeing this year, 2013 relative to 2012, and of course many saying it has been driven particularly by foreign demand. Is the momentum still there? Are you seeing that across the board?
Actually, yes, and it seems to be growing day by day. Actually, what we're seeing is a lot more foreign investors coming in every week. Looking at medium-term papers between 5 to 10 years. But actually this week we've seen some foreigners actually going longer and picking up 15-year bond papers. Mm-hmm. So it's quite interesting. And with these inflows, actually what Solomon mentioned, they're coming in, and we expect them to continue coming in for the remaining part of the year. And mm-hmm. also what we're seeing, as interest rates continue to come off, we may also see a lot more inflows also come into the foreign inflows come into the equity market as people begin to chase returns.
So that being,
I think also to just support Ken, what's happening also is we've seen from the current auctions, especially for the T-bills, the 1-year T-bill last year, the last auction, the subscription was 19 billion, but central bank took 4.2 billion. Mm-hmm. So it's clear that the rates are coming down, and that's supporting the yields on the bonds.
Mm-hmm. I mean, what is interesting, of course, is the remark around the fact that interest rates could, strengthen the case for getting into equities over and above fixed income. Do you see a switch taking place, Kenneth?
Somewhat, yes, we have seen a switch, especially when you look at institutional investors such as fund managers who manage pensions. What happens is basically you have to be in the best performing asset class for that year, or you'll pay back, or you'll pay for not being in that asset class when you close the year and the performance is being looked at. So basically what we've seen is a lot more investors are increasing their asset allocation to equities and reducing this on fixed income. Of course, we expect fixed income to have a positive return by the end of the year. Maybe you're looking at over 20% return. But I think when you look at, we expect a much more stronger return from the equity market, upwards of 30%. So of course, we will see the asset allocation towards equities increasing.
Let's just go back to the shilling right now, because we've been talking about the falling interest rate environment, and I suppose the question is, firstly for you, Solomon, do you think that the central bank is likely to cut rates further from here on out? And how do you see this specifically playing on the shilling right now?
At the moment, what's going to drive the shilling is actually economic activity. If you look at the economy from November last year, it was more or less in a lull period. The economic activity was actually very subdued. If you look at it from a credit point of view, the credit actually was not growing. It was down to 7.1% year on year if you compare to the previous periods. It's been declining all the way from the year 2011 as a result of a tightened policy. So what's happening currently is, with the new government, the interest rates are coming down to spur economic growth. And from these, what's supporting the shilling again is the balance of payments, because you're getting a lot of inflows coming in the equities, currently supporting the shilling. But the overall current account deficit is still low, which is something that the investors will be looking at more keenly to see how the government is going to tackle the current account deficit. So for now, I think the momentum is still for a strong shilling based on the positive economic sentiments. But if the interest rates continue going down, you might see it depreciate marginally, maybe give it a figure of about 3% year on year.
From a shilling perspective right now, when it comes to those levels the central bank targets getting into the market, I mean, where do you see the markets, where do you see the levels being attractive for the central bank to build reserves? Of course, if we're talking about reserves sitting at $5.6 billion right now, do you see them wanting to increase that? And of course, in light of this concern around the current account deficit?
I think if you look at what has happened, a move from 4.9 billion to 5.7 billion in terms of the increase in the reserves, with the little effect to the shilling, it tells you that there's something happening. And I think, as Ken had said, we're seeing a lot of activity in the equity market, in the bond market, that is actually currently supporting the shilling. So what's happening currently is a fact that economic growth is being viewed, and we're also looking at what policies the government will look at. The only major worry for the shilling currently is the overall current account deficit, which we expect the government to actually address in the coming few months.
Kenneth, from a bond perspective right now, let's just talk about long-dated bonds, because you said a lot of interest for 15-year debt, and then Kenya looking to issue a 20-year bond. So what type of appetite do you expect coming through for that? Who do you expect to invest in that? And then any specific forecast when it comes to the coupon rate?
The coupon rate has actually been announced to be about 12%. In terms of appetite, we expect, I think, huge oversubscriptions. Looking at the value of the bond being issued, it's 10 billion shillings, which is actually a drop in the ocean if you go by the last 4 auctions we've had this year, all of which have brought in over 40 billion in subscriptions. So we do expect a huge oversubscription. As I mentioned, we've seen a lot more investors who were risk averse and thus who are staying on the short end begin to increase their tenor in terms of their investments. So we're looking at a lot more interest in the 10-year and the 15-year. And also in the secondary market, since the announcement last week, we've seen a lot more interest coming in for the 20-year bond, not just from insurance companies and fund managers, but banks as well. So this just goes to show that basically market sentiment across the board is the same, that everyone expects rates to come off. And of course, when interest rates are coming off, it always pays to have a longer duration. And looking at expectations on the rates, I don't want to speculate so much, but I think from market analysts are pegging it maybe around between 13 and 13.5%.
And we just had the numbers coming through for the latest T-bill auctions. I'll just read them to you. We had a 207% oversubscription. That's for the 182-day paper. 6.2 billion shillings is what they overall received there when it comes to bids. And then yields ticking down in 182 to 9.98%. You've also got the 364, so one-year paper going at 11.153%. So overall, I mean, how much lower is short-dated yields are short-dated yields going to go? Because of course the 182 still sub 10%.
Wow, actually I'm quite surprised at the dip in the 360-40. 11.1 makes it actually about a dip of almost 85 to 90 basis points in one auction, which is quite surprising considering the central bank has actually been trying to manage the drop in this rate. So I expect going forward we should see this begin to slow down, because as Solomon has mentioned, as rates come off, we should expect an effect to start being felt on the shilling probably in the second half of this month and also in the coming months. So I think central bank will really be out to manage the decline in this rate.